What is certainly true is they are much more avoiding risk. Leverage is much lower. We have seen offers, and we've been presented offers for acquiring existing office buildings, slightly reversionary, and I guess they were somewhere up to 60%, availability of foreign capital at very, very interesting sub-3 yields. So my feeling is, but that was the latest incident that was indeed for a performing building. So that didn't seem to be much of a problem. And by the way, we don't want to lever any higher than that. So that was an issue for us. And we'd never buy anything on the basis of high leverage, but rather looking at the asset fundamentals and the capital value, see that this works anyways. So I guess my feeling is it's a prudent market, and it's a market where capital is available, not endlessly. And obviously, if you want to lever to have a two-digit performance, you'll probably have a problem finding that capital.
Okay. And Esther, from your point of view, financing, is that creating issues for you in terms of the investments that you're looking at here in Spain?
It is absolutely a constraint on the current basis. I mean, and it's preventing most of the added value risk profile and most of the development profile is extremely difficult for it to happen because of the lack of financing. And it goes for any sector. Particularly for resi, I would say that it's very interesting because it's possible to launch a development for residential, provided that you are intending to sell it. But I would say that any real estate player can come from the residential for let schemes to be an extremely interesting opportunity, and this is not happening simply because there is no way to put a financing in place for a scheme like this one to go ahead. And it's really a shame because probably some of the best opportunities that the Spanish market can offer today, linked to repositioning, linked to development for letting resi in some other sectors as well, are not happening because of the banks not being ready for that. And yeah, I would say that it's crossing out a significant part of the risk profile out of the story.
I think that the momentum in the resi in Spain and the banks, it's, sorry if it's any bank here, it's funny on one side, schizophrenic in other. So the banks still have huge exposure to real estate, So any risk committee that it's evaluating something related with resi, he reminds what happened with the resi crazy bubble a few years ago. So to go to a committee with a resi approval, in some sense, for the banks, it's hard. It's really hard. Having said that, they like resi because they have no idea about commercial real estate in Spain. They need resi, and they want to give mortgages to people. So say, I need this business. I cannot be out of this business. What the hell I do? No? So this is what's happening today. So the first say, don't worry, bank. Land, here you have the equity. I buy it. It's mine. It's my risk. Come on, the capex. You are ready to do that, yes? Oh, no, yes, Juan. If you have the equity in land, okay. Capex is the bank. This is solved. They are doing it. It's done. Next step. They want my capex because they want the mortgages. So they want subrogation and say, hey, now you are competing again. I like it. You all of you want my capex, no? You will have to finance a little bit of my land. No, Juan. We cannot do that. Come on. So, second phase. We are there. We are almost there. They are ready to finance a little bit the land. With extreme change with the past. The party, we pay part of the party. I mean, there will be equity always in land, And this is the best regulator for the market. If I put my money, don't worry that if you pay the land, I pay 15% more, bank, 15% more. Are you ready to pay? Come on, let's go. This will not happen again. There will be always equity in land, and this is critical. And we are with the equity, and in our deal we have a lot of hundreds of millions or billions of equity in land. But the market, it's evolving. CapEx is there. They really want mortgages. We already have 300, it's published, 350 million of corporate debt against land. And then will come the capital markets. All on the basis of an industrial model with equity, with serious and rigorous decision makers, with risk policies that make sense, and financing will be back. And we need financing in this business. It's really capital intensive.
Okay, good. Ramiro, you just come in on
I
that.
was kind of trying to support that view that finance will come, particularly inside BNP Group. I have to say that for financing real estate, we remain in that core prime segment of the market for the moment, right? But in terms of a general perspective, what we've seen in recent analysis was that we check out what the banks were saying about their projections in credit demand coming from businesses and from families for mortgages. Their view permanently, since the recovery is going to increase, is going to increase in 3 months, in the next 3 months. At the same time, they were asked about their standards to allot credit. And those standards have not stopped to get harder and harder since 2007. So even with the recovery, the standards coming from the banks to allot credit have not eased. Now, you want that to avoid risk credit, but you want them to ease the conditions to assign credit for the businesses, especially property business, to keep on. Now, my view on it is that is going to come because they have hardened and hardened the standards for assigning that credit for so long that they are missing opportunities. I mean, credit for real estate for a bank is strategic, and it's a project in which they want to enter with the investor, with the developer, and it is juicy, so to speak. So they will come back to the value-added strategies, but provided that they have studied very well the project they want to participate in. That should happen next year, 2 years ahead.